Welcome, everyone. Thank you for joining us this evening for Unpacking the pied-a-terre tax, Prepare Your Co-op or Condo. My name is Rebecca Poole, and I am the Director of Membership and Communication for the Council of New York Cooperatives and Condominiums, otherwise known as CNYC. For those of you who are not familiar with us, CNYC is a member-funded, not-for-profit organization that provides education, information, and advocacy for co-ops and condos in the 5 boroughs and beyond. We're happy to bring this presentation to you tonight. With me are Andrew Freedland, a partner in Herrick's real estate department and co-chair of Herrick's condominium and cooperative practice. He focuses on real estate and cooperative and condominium law in New York City, where he serves as general counsel to the boards of directors and managers of numerous corporations, condominiums, and homeowner associations throughout the New York metropolitan area. His clients range from multi-building luxury complexes to small brownstones and include buildings converted from rental premises, as well as new construction projects. Also with us this evening is Mark Limardo of Herrick. He delivers practical tax planning across a broad spectrum of industries and transactions. Mark counsels public and private companies on mergers and acquisitions, domestic and cross-border, startups, joint ventures, capital market, financing transactions, real estate acquisitions, and dispositions, and other business dealings in which tax considerations play an important role. Mark is also experienced in the use of federal and state tax credits, including opportunity zones, low-income housing credits, historic tax credits, new market credits. He has worked on all sides of these transactions, representing developers, tax credit investors, syndicators, community development entities, consultants, and lenders. Robert Pollack of Marcus and Pollack is a graduate of the University of Rochester and Fordham Law School. Mr. Pollack began his career in real estate taxation as an appraiser, preparing valuation studies for use in tax certiorari trials. He is a former senior assessor for the New York City Department of Finance, where he worked closely with the New York City Tax Commission. Since 1987, Mr. Pollack's prior firm, Robert M. Pollack, has represented major real estate owners and developers in real estate matters in New York City. Mr. Pollack has been successful in establishing many precedents in property tax exemption and assessment policies for complex development projects. In addition, Mr. Pollack has spoken at numerous CNYC classes and helps prepare the presentations for the Action Committee for Reasonable Real Estate Taxes. Finally, also with me tonight is Jeff Rose, a board member of the Council of New York Cooperatives and Condominiums, also, and a board member in his cooperative in Manhattan, and has helped CNYC prepare testimony and legislative amendments in regards to this issue. So welcome, everyone. Thank you for joining us. And I'm going to turn the floor over to Mark and Andrew.
Thanks, Rebecca. Thanks, everyone, for joining today. We got a bit of ground to cover, so we'll jump right in. So the pied-a-terre tax, which I will call, because I can't say it too often, I'll call the PAT tax, is a property tax surcharge that will apply starting on July 1 of this year. It applies to residential co-op units, condo units, and 1 to 3 family homes. This is a surcharge in addition to your regular tax. It's going to go into effect in 2 phases, what's called phase 1, and Andrew Freedland will talk about this in a second. Phase 1 based on the existing property tax rolls as they exist today, and then theoretically, the city over the next 2 years will be updating their property tax rolls and bringing those market values more in line to what they actually believe they are. We have the charts up here. I mean, I put the 1 to 3 family homes up there just for the sake of completeness. The rates are pretty significant on $1 to $3 million of market value, where the legislation believes translates to an actual $5 million market value. It's 4%. So at the low end of the range, $1 million market value condo co-op is looking at an additional $40,000 of taxes a year. So those are pretty significant numbers, particularly on the lower end. There's a separate scale for 1 to 3 family homes. And then starting in the 28-29 fiscal year and beyond, there goes to 1 rate. This tax is going into effect on July 1 and based on the state of the world in effect as of January 5th. Andrew?
Thanks, Mark. So, yes, as you mentioned, we have two phases of tax. Phase one is going to be for the next 2 years, starting July 1 of 26 through June 30 of 28. Those are the two fiscal years that we have. The city's tax rolls are done July 1 through June 30th. So that's the next two tax years. It's going to be based on DOF market value of 1 million or more. On your tax bills, you will see that there are two different valuations there. There's market value and there's assessed value. You need to look at the number that shows the market value. That's the number you're going to be using to determine if you're subject to this tax as far as monetarily, whether you're subject to it. We're going to be talking about for 20, 30 minutes, but as far as financially, if that number is 1 million or more, that's where you start to become subject to it. In phase two, starting in 2028, it's going to be for DOF market values of 5 million or more. So you're going to have to wait and see what DOF does with respect to the market value on your co-op or condo before 2028 to determine whether you're going to be subject to it starting for that July 1, 28 fiscal year. And as Mark mentioned, the Department of Finance will be reevaluating market values over the next 2 years. Originally, when this tax was first proposed, they were talking about valuation as far as what sale prices in the $5 million range, and they're saying that the DOF market value of 1 million or more is where they believe that 5 million of actual sale price is equivalent. And based on what we're seeing, we think this is really, I'm told, for larger buildings, it's about $3 to $4 million in actual market value. With respect to smaller buildings, the numbers are probably a little bit lower. It's probably closer to about $2 million when it comes to actual market value for some of the smaller buildings.
Okay, so the PAT tax applies to pied-a-terres, second residences, any residence that's not used as a primary residence. Despite its importance in the legislation, it's not defined specifically. Is it domicile? Is it something else? Your co-op condo unit qualifies as a primary residence. You got to actually it's you're already sort of locked in. You're going to look back to January 5th of this year and see if it was used as a primary residence on January 5th. It qualifies as a primary residence if one or more of the owners, natural people only, no trust, no LLCs, occupy the co-op condo unit as their primary residence. Immediate family members of the owners, and that's spouse, child, sibling, parent, grandparent, or grandchild. So if you bought an apartment for your kid who's going through college or whatever, and they're living there as their primary residence, that will count. Or your family's not living there, but you're renting out the property, as long as one or more of the lessees is occupying your condo co-op unit as a primary resident. So if you're renting out your apartment to somebody who's not living there full time, you're going to be paying the PAT tax. If you own your condo or co-op through a business entity or a trust, these rules will be applied on a look-through basis to the beneficiaries and the owners of those entities. And again, if you are relying on the lease exception, where you're relying on your lessee to get you over the primary residence hurdle, that lease has to have already been, there's nothing you can do now. It had to be in effect as of January 5th this year. If you decide to go to your tenant, get a written lease in effect, ask them if they're living there as their primary resident, you're out of luck for this year already. So who decides if your condo or co-op unit is a primary residence? Well, it's kind of an interesting process, and frankly, it's a potential trap. So this is not being handled like an income tax where, every, April 15th, July 1, you're going to fill out a return and you're going to tell the city whether or not you're using your condo or co-op as your primary residence. That's not what's going to happen. The city is going to make an initial determination based on the information, quote unquote, the information available to the city. The city is then going to send everybody, and they're basically going to match on their records, figure out based on what their records have, whether somebody's using the condo or co-op unit as their primary residence. What that really effectively probably means is that they're going to look at income tax returns, see if an income tax return was or was not filed, listing the condo co-op as the permanent address. So a missing income tax return or an income tax return for somebody who filed as a statutory resident, not as a New York City domiciliary. And by statutory resident, that's the numerical test that says if you maintain a permanent place of abode in New York City or New York State, and you're here for more than 183 days, even though New York is not really your domicile, you're treated as a resident. By going through that test, you're essentially admitting, by saying you're a statutory resident, you're essentially admitting that you're not using the apartment as your primary residence. So again, New York City is going to send you that notice. The first set of notices is supposed to go out by August 30th of this year.
Mark, before you go on, if you could just explain for people what it means to be domiciled in case there are people here that don't.
Yeah. So sure. Domicile is a dreaded facts and circumstances test. It's the place where you intend to return. So that's like, so if you go and live in France for 5 years for work, but you really, you're always planning to come back, New York is your domicile. And there's a whole set of factors that the state and the city go through to say, well, you really intended to come back, where your voting records are, where your driver's license are, where you go to, where your religious affiliate, what church or synagogue you go to. But that's not going to show up on an income tax return, generally. So the statute, most people who live in New York are New York domiciliaries. The people who trip over the statutory residency test is somebody who lives in Florida half the year and then spends half the year up here. But it has all their voting records and driver's license in Florida. So and they're Florida domiciliary, but they trip the statutory test.
And Mark, we should also mention they're probably going to be looking at condo co-op abatement records to determine who is a resident, who's not a resident. So that's another way that they're going to
the star exemptions, anything else like that. So New York City is going to send you a letter by August of this year. And here's the trap. You have 30 days to respond. If you do not respond, you are subject to the PAT tax. So if you're like me and you get all your important stuff by email, my wife is always yelling at me about this stuff. You throw your mail on your desk for a month and, you come back, you look at it, every 2, 3 weeks, 4 weeks or so, you're going to be trapped. And according to the legislation, there's no right to appeal if you miss that deadline. Now, whether that is going to hold up in court, I don't know. I tend to think that's a violation of due process, but, we'll see. And I think a lot of people are just going to fall in, they're not paying attention, throwing the mail on the desk, the mail is going to its Dropbox. That's the trap. So again, to get out, you got to show it's a primary residence. There are a couple of other exemptions. Any condo or co-op that doesn't have a temporary permanent certificate of occupancy. If there are any sponsors out there in the audience right now, any unsold units are not subject to the PAT tax while you hold them as the sponsor. If you transfer them, you will lose this exemption. And being an income tax lawyer, there are tax planning techniques out there where sponsors who have unsold units will transfer those units to an affiliated entity so they can try for capital gains. That planning will now attract the PAT tax. Andrew, over to you.
Thanks, Mark. So the question is now, how does this affect your board? With respect to condominiums, it's a little bit easier. The effect on operation of the condominium with respect to this tax is really minimal. Condominium owners pay their real estate taxes directly to the city. They will receive tax bills. And if they are subject to the PAT tax or the pied-a-terre tax, those will be posted on their real estate tax bills, we believe, starting January 1 of 2027 for the fiscal year that starts July 1 of 26. Again, as I mentioned before, fiscal year for the city is July 1 through June 30th. So they're going to be looking to put the charge on the tax in around January 1. So for the board, minimal disruption to you. owners who are subject to it will pay their bills directly to the city. For those of you in cooperatives, not quite as easy. This is going to be a little bit more complicated. As you co-op board members and shareholders know, your real estate taxes are paid at the building level. Your building is one tax lot. You pay your maintenance each month to the board, and the board then uses that to pay real estate taxes as they come in, and obviously the other operating expenses of the co-op. So the co-op boards are going to be subject to a little bit, there's going to be a little bit more for them to deal with. First of all, co-op boards are going to be required to furnish information to the Department of Finance because the valuations on the tax bills are for the whole building, not for the units themselves. So Department of Finance is going to be calculating what the valuation is for each unit in the building that's subject to this tax. With respect to cooperatives, the market value, as I mentioned, is for the whole building. So how is DOF going to determine what the valuation is for an individual unit? They're going to use the shares. They're going to use the share amount allocated to each unit divided by the shares for the entire building. That fraction multiplied by the market value, not the assessed value, the market value shown on the tax bill is going to be the number that they focus on. And then if you fall in that 1 million or more number, you would be subject to the PAT tax, obviously, if you meet the other tests as Mark described. The Department of Finance will then be posting to each co-op's tax bill the pied-a-terre tax allocated to these units, and the co-op will need to pay it to the Department of Finance and then back charge it to the shareholders that are subject to it. Co-ops that escrow their taxes with a mortgage holder may be looking at a substantial increase in their monthly payments towards their escrow accounts. I think right now, the lenders probably just don't have the information available to figure out how this is going to affect the co-op's tax bills long term. And so they're probably not going to be doing much right now. But I think once year one passes and they see what it does to the tax bill, they're probably going to be looking to change the escrow so that the bank is not caught without enough money going forward to cover real estate taxes.
Andrew, sorry, before you go on, there's still some confusion about market value versus actual sales value and why there's a difference. And also, if it's 1 million market value now, why the jump to 5 million in 2 years?
Sure. So the market valuation is the market valuation that the Department of Finance comes up with. And with respect to co-ops and condos, when those properties are valued, they value buildings, and I'm sure Robert will talk about this later, they value those buildings as if they were rentals. So the valuations are a little bit different on co-ops and condos. That's why there's a difference between the DOF market value and the actual value that you would sell an apartment for on the open market. Then when they do assessed value is based upon the market value. Assessed value is generally about 45% of market value. But again, Robert will probably talk about this a little bit later. He's the expert on valuation and real estate tax like that. So I'll leave that for him, but that is correct. So if you look at your tax bills, for those of you out there who are co-op board members or in a co-op and you want to see what the market value determined by Department of Finance is with respect to your building, if you look at the real estate tax bill, you will see there are these two numbers. There is a market value and then there's an assessed value. So those are found right on your tax bill.
And then there's another question, which is more logistics, and I don't think we know the answer to this yet, though we can make assumptions, which is, where is the Department of Finance going to send this notice to the co-op? Is it going to go to the property manager? Is it going to go to the building? Not the one that will go to the individual shareholder unit owner, but to the co-op board itself.
I would have, I don't think we have the answer for that yet, but I would imagine they're going to be reaching out to wherever the real estate tax bills are sent, which is most likely your management company. Although in the case of, I guess, buildings where there are lenders on them, they're probably going to send a notice to both the lender and the management company. But really, this is an issue for management. That's where this information is going to come from the managing agents. So if the notice comes to the building itself, you're going to need to pass it on to management, because that's really who ultimately is probably going to be addressing these for you.
There are a couple legal questions on how co-ops can assess shareholders not on a per share basis, but maybe we should go to that later.
We're going to talk about that in a little bit. I mean, with respect to it's a very fair question under IRC 216. Co-op shareholders are supposed to be assessed per share. The statute here specifically calls for the tax to be passed on to the shareholder in question. I think that from the perspective of the co-op, this is sort of like the condo co-op abatement in reverse. The condo co-op abatement, the city comes to you and says, here's the amount that you return to the shareholder. And in this case, it's going to be the reverse. Here's the amount that you need to assess to the shareholder based on the pied-a-terre tax. With respect to collection from shareholders, again, as I mentioned, cooperative corporations will initially be required to pay the surcharge, which could be a burden for the co-op, especially smaller buildings that may have one or more units subject to the surcharge. The failure of the shareholder to pay the co-op will not absolve the co-op from paying the tax as shown on the bill. So co-op, you will need to pay that and then post it to the shareholder's individual bill so that they can reimburse it. On the front side, co-ops, you may have to dip into reserve funds if you don't have the funds in your operating account to pay this. And then when the shareholder in question, or shareholders, more than one, pay you, you can then go ahead and replenish your reserves. But, you may need to dip into reserves in order to pay it in a timely manner. So then I guess the question is, what happens if the shareholder doesn't pay? Well, co-ops don't have the same tools at their disposal as taxing authorities do to collect taxes. If you have a shareholder that does not pay, you're probably looking at proceeding with a non-payment action against them. You're probably looking at going to landlord-tenant court in order to recoup that. And yes, it can take months if the shareholder does not pay. It could take even longer depending on, the procedural posture of the case and how things shake out with respect to the courts. But you may be looking at proceeding with a non-payment action. That's generally going to be your method of resolution. If the PAT tax is not paid on the bill the bill when you first post it, I would strongly suggest to any co-op out there that they immediately proceed with landlord-tenant action, because you don't want to let this go. You don't want to give the shareholder 60, 90 days to pay, and then, you're not getting paid. And then all of a sudden you're looking at starting a case. Then if it's not paid, I would strongly suggest that you immediately move forward.
Okay. I just will add that, I think that it's prudent if you see that you have apartments that have a market value of over $1 million, if you do the calculation yourself and see that there are those in your co-op, particularly that you communicate with those shareholders so that they're aware that this may be coming.
Yes, especially if you know or have reason to suspect that those units are, owned by individuals who don't occupy them as primary residences. Absolutely, very good advice, Rebecca. With respect to how does the co-op protect itself? Well, if you have a new purchaser who's coming into the building and you know they're going to be owning their unit and not using it as primary residence, you may want to ask them to deposit an escrow. And the co-op can hold that to ensure that you have the money to pay the pied-a-terre tax when it comes through. So that might be one tool. Not as easily done with existing shareholders, but for new shareholders, that may be a good idea. Co-ops also need to ensure that upon sale of an apartment, steps are taken to advise the Department of Finance of the change in the status of the unit from non-primary to primary, if that is in fact what's happening. And an escrow may be necessary when a non-primary resident sells to ensure the tax is not charged, leaving the co-op in the middle having to pay it. You don't want to be in a situation where a non-primary resident sells to a resident, the tax is levied after the shareholder leaves, and the shareholder who's in there now says, well, I'm not paying it because it shouldn't be billed to me. It should have been paid by the prior resident. And the co-op is in the middle. You have a former shareholder who's no longer there, who it's going to be difficult to get that money from. You may want to address that at closing. It's something that managing agents, closing agents, law firms, attorneys who act as transfer agents are going to have to add this to their checklist.
Yeah, Andrew, also somebody dies. You need to be cognizant of that.
So
right now,
true.
it's not clear what happens when an apartment goes into an estate. No, those rules are still a little bit of flux. So you have to monitor any change of ownership.
Yep. Thank you, Mark. And you may want to consider rules to determine who may or may not be a primary resident to assess the overall building liability when the tax is charged. So, you may want to ask people to register with the co-op whether you're primary or non-primary so that we can determine which units we believe are going to be subject to the tax so that we're aware of it and we can kind of get ready for the payment that's going to be due from the co-op. And as I mentioned before, you may need to dip into reserves to pay this because you will have a limited time to pay, and then you're going to have to pass the tax on to the individual shareholders.
There's a question that's sort of related to the question about the estate, which is what happens if purchasers purchase the apartment after January 5th this year? It's their status, or what if the apartment is being renovated in January?
Yeah, so I guess the question is, on January 5th, the apartment was a pied-a-terre. You closed on January 7th and moved in as a primary resident, and now you could potentially be subject to this tax. That's an interesting question. Mark, what do you think about this one?
I think you're locked in. I think you
You
kind
may
of
be.
stepped into it. You may get out because you don't have a TCO. I mean, if you're doing renovations, maybe you get out under that, but I think you're locked. And that's a very good point. As a purchaser, you're going to want to be cognizant of that.
Yeah, I mean, as a purchaser,
It's a proration of the property tax after the closing.
yeah, as a purchaser, if you closed on January 7th, let's say you didn't even know about this tax, this wasn't even a thought, comes along months later, you could potentially be subject to it.
We have some questions on the calculation of the tax itself. So I don't know if you want to go back up to your first slide or not, if that's possible. Question is, if your market value is $4 million, are you taxed 4% on 2 million and then 5.25% on the next million? How does
No,
it?
it's not a graduated. You don't go up through the brackets.
So it just goes through whatever bracket it is. So if you're at 4 million, what would the tax be?
Yeah, it would be 5.25% of that market value, or in this case, $210,000.
Yeah, you don't get. It's not like income tax where you go up through the brackets.
There you go. Yes.
Yep. There you go. Okay. There you go.
Yeah, so it's going to be 5.25% times 4 million.
There's some questions on the board's liability. So is it possible for the board to be sued for paying taxes that are due from an individual shareholder out of their general account?
Well, they're not due from an individual shareholder. They're posted to the co-op's bill. The co-op is initially liable for them. So you have to pay them to ensure that the co-op doesn't incur late fees. At least the way the statute's drafted now. You would then pass it on to the shareholder. And in theory, assuming the shareholder pays when it is posted to their maintenance bill, which you should do in the immediately following month, you'd only be fronting the money for about 30 days. And it should be an in and out situation. The money went out, it comes back in, hopefully within a month. The tax bill is initially due by due from the co-op. So you're going to have to pay it. And that's the way the statute, is drafted.
And if the question, there's no personal liability for the director. It's not like sales tax.
I don't know if we really know this question yet, but will they back out the commercial portion in co-op since they don't have shares?
That's a very interesting question.
Is that in the valuation, Bob, the commercial space?
Yes, a co-op is one block and lot, so it encompasses everything within that building envelope. Though what the statute reads is you take the number of shares of your unit over the total number of shares issued. So in a sense, and of course they cannot impose PAT tax on the commercial, it's just for the residential units. You will get your pro rata share and the commercial will not be billed any PAT tax.
Yeah, but it's going to pull the commercial value over to the residential side, right?
But the shares that were allocated to the commercial are not, no one's paying on those shares.
I was just going to say, I think with respect to certainly co-ops, those buildings out there where they are condops, and to clarify, the sponsor created a condominium or a 2-unit condominium or a multi-unit condominium and put the commercial units into a separate tax lot. And the co-op is a separate tax lot from the commercial. It seems like at least at this point, the sponsor did you a huge favor today in doing that, because the assessed value on the commercial is not going to be part of the co-op's tax bill. For the co-ops where they have sponsor who did a commercial lease for a term of years that, in most cases were 75, 80 years, and those are still going on, and the sponsor pays a certain amount based on that lease to the co-op every month, every quarter, every year, whatever the payment may be, they may have a little bit more of a difficult time dealing with this. So it's an open question that we just can't answer yet.
Another question. We had supplied on our website a link to the Department of Finance's PIP portal where it lists the current market value and the current assessed value. Do we know, is that the market value that the Department of Finance is going to be using?
Yes. In other words, the market values that currently exist on the Department of Finance website are the 26-27 market values, which were published in January 15th of 26, long before we even envisioned there'd be a PAT tax.
Before we knew how we'd be referring to them. Okay, Andrew, this is a question on how a co-op can try to collect from the shareholder. So if a shareholder has a mortgage, can the co-op board not go directly to the lender if the shareholder doesn't pay, just like you would do sometimes if a shareholder's not paying maintenance?
Definitely a matter at your disposal as well. If you do have a lender on it, go ahead. You do go through the normal procedures. You notify the lender under the terms of the recognition agreement, and the lender may very well pay it. And of course, that would be absolutely beneficial to the co-op. The shareholder wasn't paying, and the lender, went ahead and cured their default. That would be great.
If a shareholder owns 2 apartments, each of which has a market value of less than $1 million, but the combined market value exceeds $1 million, I don't think we really know yet what the Department of Finance is going to do. It probably is going to depend on whether or not the units are combined. What do you think?
I think that's right. There's a rule in there about condominium units, actually. They'll let you divide your unit up into 3 before they go after you for trying to get around the tax. So I think, yes, I think it's going to come down to whether they're combined or not.
There are a couple more questions on the commercial.
Of course, if they're not combined, I think only one can be your primary residence.
Right. We actually have some problems with that on the co-op condo tax abatement side, where shareholders have been denied, even though you are supposed to be able to claim for 3 units in a building. There are a couple of questions on how the commercial units are going to factor into this. And I don't know, perhaps we can get back to people after the webinar, unless you want to go into that broader now.
Bob, I don't know if you have anything to add on this. I mean, there are situations where you have a co-op with a, a 99-year commercial lease, no shares allocated to it. The valuation includes that.
One sort of last question on corporate governance. Do you recommend an amendment of the proprietary lease to address the issue that assessments must be done by shares, or do you think that's not necessary?
It's a very good question. I think, for right now, the statute basically says that you pass it on to the shareholder. So I think you have enough to pass it through based on the statute. But depending on where this goes, maybe it is something where an amendment to the proprietary lease becomes a good idea, going forward to just cover this issue.
Thanks. And here's one more on the whole transfer issue. The shareholder subject to the PAT tax sells. The new shareholders assess the PAT tax, but the former shareholder was only subject for a portion of the year. Will the subsequent shareholder be able to petition Department of Finance to prorate the tax?
Well, the answer is I don't know, but probably not. But this is what we were talking about when I was saying it may be an idea for closing agents to put this on your checklist. This may be something you need to deal with going forward and collect escrows from people as they sell to make sure this issue doesn't come up.
Thanks. The remainder of the questions lead into the next component, which is going to cover the rules a little bit, and questions about, there's a question here, will co-op get a copy of any letter sent to the tenant shareholder by August 30th, asserting that the tenant shareholder is not a primary resident? Jeff, do you want to answer that based on the rule development?
I'm happy to talk a little bit about it. At the moment, the rules are not very clear in a number of respects. And one of the respects in which they're not clear is the degree to which the co-op is going to have notice of everything that happens in connection with the assessment process, the penalty process, any hearing process. And one of the comments that we're going to be making is to request that they make clear that any notice of anything that happens in this process needs to go to both the co-op and the individual shareholder. Similarly, we are going to be commenting that because there are two parties in interest here, effectively, both the co-op and the shareholder, and either can request a hearing, we're going to request that the rules provide that if one of the two requests a hearing, the other is provided notice of that and the opportunity to participate. So at the moment, the answer is the rules don't really require the Department of Finance to do what we would like.
All right, I'm going to move on. There are still questions here. We'll keep coming back to them throughout the presentation. CNYC began advocating on the pied-a-terre tax, just to give everybody a concept of this, prior to the introduction of the legislation on the state level. And from the beginning, there were three items that we were requesting. One, that sales price of $5 million, would be what was actually used to determine whether or not a co-op or condo apartment was included in this tax. Two was that the co-op not be assessed for the tax, that the tax be or surcharge be placed directly on the shareholder. And three was that anybody who filed a New York City income tax return would be considered a primary resident automatically. Those things did not happen in the legislation. And we subsequently developed a request for amendment to the legislation that highlighted our main concerns. We shared it with multiple state and assembly legislators who shared it with state and assembly council. At the end of the day, at the time, it was decided that there was inadequate time to introduce and pass a bill that would amend something that was agreed upon between the governor and the city. So that is a possibility for the future, but we were unable to get amending legislation through prior to the conclusion of the this year's session. That is something that we may come back to, depending on what happens, over the next few months. We may try to get that, our requests for amending legislation introduced in next year's session.
Unfortunately, the rules and the regs that DOF promulgated are very, very light on substance. Spent 90% of the rules talking about how they're going to calculate penalties and what your recourse is for a penalty. Incidentally, if they come to the conclusion that you tried to deceive them on the PAT tax, your primary residence, they can impose a charge as high as 50% of the total surcharge. And they spent their rules and regs discussing all your rights and remedies with respect to that penalty and gave very little substance on these issues that are really very relevant. And I find particularly interesting that the state legislation actually empowers the Department of Finance to promulgate rules and regulations. And they actually gave some examples. For example, they should, what about a death? Department of Finance is absolutely dead silent. It's crickets on the question of what if somebody lived in an apartment 40 years, they pass away on December 31st, and come January 5th following, is this now a pied-a-terre because we don't have a primary resident living there? So I think a lot of this, and incidentally, the Department of Finance is going to be having a hearing on July 9th regarding the rules and regulations, and they welcome comments, and you can speak at it. And I think everybody's going to be, I think it'd be nice if we show up in force and everybody asks all these difficult questions that they haven't apparently given. If they've given it any thought, they certainly haven't committed to how they plan to deal with it.
We're going to touch on that more later, but CNYC is developing detailed comments on the rules, which we will share when they're finished, and ask for support from as many shareholders as possible to attempt to get some of the comments through. We're also obviously going to be meeting with the Department of Finance to try and discuss these, but I'm going to move forward now onto some of the items of the rules where we'll be submitting comments. And Jeff, I'll turn this over to you.
Sure. Thank you, Rebecca. As many of you are aware, the Department of Finance rules relate to the procedures for implementing the tax and imposing related penalties, and have to be consistent with the legislation establishing the pied-a-terre tax itself. So there are comments that we made to the state legislature and changes we want to make and will continue to pursue with the state legislature that we can't pursue with the Department of Finance. As Bob mentioned, the Department of Finance rules are surprisingly light in a number of areas. They have indicated that we have until July 9th to submit comments, which we're in the process of formulating. In general, the comments are basically going to cover several areas. There are so far about 12 or 13 comments that we have, some of which are fairly technical. So I'm just going to touch briefly on some of the highlights. The first is the evidence that the Department of Finance will accept. And this covers two areas. One, for years after next year, i.e. not including the first year, they will treat you as being a primary resident if you filed a New York City tax return showing that address. But we're not entirely sure why the first year should be any different, and we're going to request they treat the first year the same way. As Mark and Andrew mentioned, if a member of the immediate family of a primary owner is residing in the unit, that will exempt you from the pied-a-terre tax. But the Department of Finance will only accept as evidence birth certificates and affidavits from both the resident and the owner together as evidence of immediate family status. This presents potentially a problem because there are a number of situations in which it may not be possible to obtain such affidavits from both people. On the other hand, there are a number of other different sources of evidence which would tend to establish family status, including, among other things, marriage licenses, adoption papers, old tax returns showing dependent status, probated wills, family court decrees, and other official evidence. And so we're going to request that the Department of Finance broaden the evidence that they will accept to show family status. We already discussed some of the issues relating to the fact that there are two parties in interest in the case of co-ops and condos related to notice and hearing. So I'll pass over that issue and won't repeat it. The third issue is the audit timeline. The Department of Finance is proposing that they're going to have 6 years to audit primary residence status. This presents an obvious issue for co-ops and condos who may have thought that the primary residence of their perhaps long departed shareholder was settled several years ago. And accordingly, we're going to request that this timeline be significantly shortened. The last category, which I'm going to currently call immediate family, has 2 items. Number one, as I mentioned, the immediate family of an owner who was residing in a unit renders the unit a primary residence. It is unclear what happens if a unit is owned by 2 spouses. And we would like the Department of Finance to clarify that in such a case, a member of the immediate family of either spouse suffices to exempt it from the pied-a-terre tax. In addition, there is the issue that has been raised previously. What happens if a resident dies? And if this unfortunate instance occurs, we are of the view that the Department of Finance should look to the status of the resident immediately prior to their death. We are still in the process of formulating our comments, and so we expect that there will be additional comments as we continue to look at at the rules and at the issues that are posed by the pied-a-terre tax. So if you do think that there are any other issues that we should be commenting on, we definitely welcome any views that you have on that. Thank you.
Thanks, Jeff. I'm just going to add, we'll be sending out contact details for CNYC where you can register for e-blasts on this topic. And we encourage you to stay engaged so that we can inform you our next advocacy steps, and also so that you can submit to us additional thoughts regarding the comments.
Actually, Rebecca, I have one question for Jeff.
Yep, go ahead.
Jeff, I hadn't thought about the audit issue. What happens if they come in and audit, say you weren't a primary resident and the guy's long gone? He's
Well, I think the co-op has a problem, right? The co-op is going to have to pay, and it's not clear from who they would be realistically able to collect.
Right. So because this is unlike a regular property, this is different than a regular property tax where you don't have this audit issue.
Yeah.
Right. And it's an interesting, it's like, what do you do?
Combine it with the fact that that there's no rule for a deceased shareholder, and you have a potential problem where there is no one you can go after to get reimbursed, and it is effectively a liability of the co-op and the other shareholders who were in fact New York residents and would not be subject to the PAT tax. So we think that some of these things do need to be fixed. Both the audit timeline to limit this issue and the treatment of a deceased shareholder to eliminate this particular problem. But you could also have a situation where
it's not even the deceased shareholder. This guy moved to France, right?
Yeah, that was the next. Yes, right. that was the next hypothetical I was going to. Exactly. Right, a deceased shareholder makes it actually impossible. The shareholder who moves to France and you have no idea where they are makes it practically impossible.
And this could be if it's a 6-year ability to claw back, this could be an enormous amount of money.
Yeah. I'll just throw it out there. I mean, I don't know if it gets us anywhere, but this question comes up when you have a partnership income tax where you can have audit liabilities after somebody's departed the partnership, and you do have in the LLC agreements, there is an ability, theoretically at least, to go back and collect from the former member.
I am familiar with those provisions. It has always been questionable how realistic
exactly
it is to use them.
But I mean, do you add it just for heck of it, right?
Bob, if we could go back to how this is calculated, we actually had two more questions come up in the chat, and then maybe you could take us through some of the other questions and what you see happening, anything that we haven't covered yet. So this question is, the real estate tax for the co-op is based on the assessed value. As a surcharge, isn't the PAT tax sort of also based on the assessed value as well? That is the shareholders' ownership percentage of the assessed value multiplied by the 4%. Do you want to explain the relationship again between the assessed value and the market value?
Certainly. So, and a little bit of background. The reason that property apartments, co-ops and condos are assessed as if they're rentals dates back to 1980 when S7000 was enacted. It was a comprehensive legislative change of New York City's real property tax system in response to a Court of Appeals decision, Hellerstein, which held that our statute at the time read that all property should be assessed at its full value, uh, which was going to cause great havoc and shift the tax burden from the commercial onto the residential, and residential is where all our voters are. So the legislature realized, well, they're not going to have that happen. So they struggled. The decision came down in 1975, and it took till 1981 to actually enact S7000. What was the response? It was enacted over a gubernatorial veto, and we then ended up with a system where it was meant to be an enormous benefit to co-ops and condo apartments in that they wouldn't be valued on their transactional prices, which were very, at the time, considered very high. The legislature didn't want to tax that home ownership component. They said, let's just treat it as if it were a rental. So that's why the city goes through the process of imputing a rent into the building as if it were a rental, deducting expenses and capitalizing to arrive at a value, and they take 45% of it, and that's our actual assessed value. Not to be confused with transitional assessed value, increases in assessment are phased in over a 5-year period. So the number that really relates to the market value is the actual assessed value. The transitional assessed value is merely a mathematical function of the current actual AV and the prior 4 years. It's an arithmetic average.
So that is true for co-ops that are larger than 11 units.
Yeah, thank you. I'm going to mention two C's in a moment. Thank you, Jeff. So, and the rough and dirty, if you're in that $1 to $3 million category, because the surcharge is actually tied to the actual assessed value, we actually know that if you're going to pay on the surcharge in the phase one. If you're in that first category, you're going to pay roughly 71 to 75% of more than your real estate tax, what your share of the real estate tax is. If you're in the $3 to $5 million range, you're going to pay about 100% more, double. In addition to you're going to pay if your property tax is 75,000, you expect your surcharge to be 75,000. And if you're greater than the $5 million category, figure it's going to be roughly between 115 and 120% of that number. Because yes, they are essentially tied to the same number. When we get to phase two, that's another story. We just don't know how the city's going to handle true market values based upon comps. My quick and dirty, the more luxurious the apartment, the higher it sells for per square foot is going to experience the greatest kick up under that scenario. And Jeff had mentioned the smaller co-ops and condos because there the ratio is going to be could be vastly different. 2C properties, less than 11 residential units, so 10 residential units and less, have been benefited from a cap on the assessment increases. The assessment cannot go up more than 8% a year, nor more than 30% in any 5-year period. So the city does put a market value on it, and because the assessments are capped, a lot of them tend to be very reasonable and realistic, and nobody pays any attention to that market value that's on there. In fact, you could not even contest. The tax commission would not allow you to contest a market value, nor on a one-family home. So these have gone unchecked, and no one really cared. It could have been $1 billion on it. It didn't change your tax bill. Well, now all of a sudden, it's relevant on this PAT tax. And we ran a study of what this PAT tax would mean to certain properties. And in the 2C category, it could actually be 10 times your real property tax bill. I don't want to alarm anybody. Most of them were not that crazy, but there were certainly many that were triple and 5 times the real estate tax bill. I do want to talk about contesting the assessment. I think co-ops, and by the way, and here's another place where the rules and regs are a little sketchy, and we do have the ability to go to the tax commission, but the tax commission hasn't promulgated any rules regarding contesting these, nor have they generated any forms yet. I'm sure it will be in the forthcoming. But the cooperative corporation could actually step in and challenge this residency requirement on behalf of its unit owners. This 30-day notice that was mentioned earlier, the Department of Finance, prior to August 30th of 26 this year, are going to send out a notice that they think that you are subject to the PAT tax. My guess is they'll probably paper the world with those notices. You can respond with a certification, and they're looking for some documentation where you challenge it. And as mentioned earlier, if you don't dispute it, if you don't respond to it within that 30-day period, it's deemed to be a final determination which cannot be challenged. So it's going to be critical that unit owners are alert to this. I expect that Department of Finance will be posting this on their website, just like they post assessments. So I think that each co-op's got to be on the lookout, and not clear what they can do at this point, but we know that they do have the right, running all the way to December 30th of 26 to contest these primary determinations. So
There's a question in the chat about that. What if the letter gets lost in the mail?
It says right, even if the Department of Finance just fails to send the notice entirely, it doesn't obviate or doesn't eliminate the requirement. So they could actually not even send you a letter, and you're going to be responsible for the PAT tax, which is why I believe it's going to be posted on their website. I think that's the only realistic way they could establish, and most everything else that they do post on their website, all the assessments, all the change by notices, and so forth. So I certainly expect it will be there.
So there's a comment, not a question, that has to do with something that we've been discussing offline but haven't discussed here really. For smaller buildings, right, the pied-a-terre tax at 4% can be a substantial portion of the real estate tax bill or multiples of the real estate tax bill for a unit in the building.
That's right. I mean, 2C is a category. These buildings that have benefited from the caps have really, for the first time ever, have to look at their market values that have been assigned. And it could be, as I mentioned earlier, we see numerous examples of where it would be 10 times the amount of real estate taxes they pay.
And that's data that we're working up right now. So when we come up with something, we'll be distributing that so that we can use it in advocacy regarding this tax.
And just judging, on how they handle the co-op condo abatement, I just don't think they have the depth of organization to do anything really meaningful. I think that what they will do is just send out these notices to everybody that could possibly be a non-primary resident and make you assert with a certification that you are. And if they later find out that you're not, it's going to be a retroactive imposition. Any other questions?
Yes. Is the co-op itself going to have to interfere at all in terms of what constitutes a pied-a-terre or primary residence? If the Department of Finance contacts the shareholder, is the co-op going to be expected to respond at all as part of the proof that the person is there more than the number of days?
The rules and regs give the Department of Finance, broad rights and powers to subpoena, get testimony. So I don't know how far they'll dig into this, but certainly when it comes to other issues like establishing domicile, they have, do very in-depth audits. So they could certainly ask send somebody out to talk to the doorman. Do you see Mr. Smith here on a regular basis? So I think that's entirely possible if they want to dig in on a particular matter.
Are we expecting a lot of lawsuits on this?
I think so. This unlike the co-op condo abatement, where people, have as you're well aware, Rebecca, have have been denied their benefits, and there's very little you can do it. It's typically not a lot of money. It's $10,000 or $15,000. Doesn't really warrant embarking on a lawsuit. But the pad tax could easily be 70, 100,000, and I think it will warrant litigating.
And then this is a question where I think all of us, that track what's happening in the city are concerned. If the Department of Finance will be reevaluating the market value to align with true market value, or I don't know about true market value, it's more like comparable sales in other co-ops and condos, because they're probably not going to come into each unit for assessment purposes. But does that mean the property taxes for co-ops and condos will go up very quickly subsequent to that 2008 recalculation or before?
I think the intent here is that if they raise these assessment, these market values enormously, that they'll drop the tax rate. But, given government and particularly this administration with, a deep desire to collect revenue, I don't think that they're going to look at this as a revenue neutral shift. I think it would be an opportunity to get more money from real property tax, and I think they'd find that very desirable. I'm also concerned that if right now this law has a 5-year life, but I think it's likely once it's in place, it will be extended. And I think there'll be a tendency to possibly drop it from 5 million to 4 million, from 4 million to 3 million is always a concern.
Right, right. And it's already really below 5 million for all practical
It
purposes.
really is. And we've looked at a number of units that sold for 3 million, and yet they're getting swooped up into this phase one where they have to pay the
Right,
PAT tax, even though they are not worth anything close to 5 million.
right. Columbia University owns an apartment in our building that will be over $1 million market value, based on imputed market value by shares. A Columbia professor lives in the apartment. Will we be charged, or will the unit be charged, and therefore the co-op be charged, depending on whether the professor is New York City domiciled, and how can the co-op prepare themselves for that?
Well, I guess the question is this like a semester kind of thing? Is it a long-term resident kind of thing? I mean,
And
if it's kind of a visiting professor situation, I think you're going to be subject to it.
would there have to be some type of sublease from the corporation? Oh, it's a long-time person. It's been there 20 years.
Okay, so that's probably fine.
So you think they would consider that the same way that they do a sublease, and the professor would just have to send in their taxes?
I think so. But you have some interesting issues actually, you know, uh, with the hospitals. They give subsidized housing to their residents.
Right. My understanding was that the surcharge was not going to be added to the co-op's tax bills, but that it would be reflected on the tax account. And would there be any potential liens against the co-op if there's non-payment against that surcharge?
Well, tax account is the equivalent of their tax bill. What they're referring to is if you go on the DOF website, you'll see your statement of account. It includes your real estate taxes. It will go on there. If it's not paid, it will accrue interest at the rate of 16%. And could be enforced by the same means that they enforce real property taxes, which ultimately can be seizure of the property through an in rem proceeding, or they can engage the sheriff.
Right. Okay. That clears the question deck. There are a couple of items that I've pulled down that are outstanding, and we'll get back to you with further information on those as it's released, and as we proceed with our comments. Do any of you have last remarks before we sign off?
I urge people to attend the July 9th meeting. You can attend remotely, and you can submit your comments and your questions.
Just want to say thank you very much, everybody, for attending this evening, and we'll work on getting recording out. Thank you, Mark, Andrew, Bob, Jeff, for helping us pull this together very, very quickly.
Thanks so much for having me.
Thank you. Thank you.
Thanks, all.
Good night, everyone, and we'll be forwarding additional information. Thanks for attending.